BlockFi, Celsius, multiple companies. There was like Voyager, which was it was a good company, blew up. So it doesn't matter whether you run it from your garage or you have an office on the Wall Street. It's a question of how you build your product in a way that you can appeal both to Bitcoiners and both to traditional finance people.
In a world where traditional finance meets the disruptive force of Bitcoin, the conversation around lending and borrowing takes center stage. Max Kay, a leading voice in the Bitcoin community, delves into the complexities of bridging the gap between borrowers and lenders. Kay navigates the complexities of custodial concerns, yield generation products, and the inherent value proposition of Bitcoin itself. Join us as we delve into the future of lending against Bitcoin and the pivotal role of collaborative custody in shaping this transformative narrative. With a keen eye on the pitfalls of custodial solutions and the promise of multi-signature technology, Max advocates for a new approach to generating yield on Bitcoin assets. Join us as we explore the evolving landscape of Bitcoin lending and the principles guiding its future. Before we get on with the video, we'd like to introduce our sponsor, Stampseed. Follow the link in our description below for 15% off your stamping kit. Furthermore, 77% of our viewers on this channel are not yet subscribed. If you are enjoying this content and want to support our efforts, please hit that like and subscribe button and help our videos find more people. Without further ado, here is Max Key on the Preston Pysh podcast.
I think that the main problem, and actually Lynn later on the same panel, she mentioned that there are companies that actually allowing you to do it in a proper Bitcoin way. And she mentioned Unchained Capital, which is a multi-signature based, basically lending and borrowing, and which we do with HODL and with Netlify as well. So I think that the main issue that not many still yet understand, that there's a huge gap between borrowers and lenders, in that sense that if we say that lenders are traditional finance companies, big institutional companies that are used to take custody of the assets, and we say that they want to start lending out money to Bitcoiners or to companies that own Bitcoin on the balance sheet, that there's a huge problem because Bitcoiners and companies, whether it's a legal entity or a private individual, they saw what happened with BlockFi, Celsius. They saw what happened in 2008. They saw what happened in general with when you give a custody of your assets to someone else. I disagree that these companies like BlockFi, Celsius, they were run from a garage, basically. Maybe obviously there was some bad decision made, bad risk management. But in Bitcoin, I think the main value proposition, one of the main value propositions of Bitcoin as a superior asset, and I think Michael will agree with me and generally what he promotes as well, is that this is something that you own. If you have a key to your Bitcoin, this is your asset. It's independent from everything else out there. You don't need to custody those. You take a hardware wallet, cold storage, you send there your Bitcoin, that's it. That's your asset. So when we're talking about Bitcoin borrowing and lending and mentioning the custody, maybe Wall Street and other traditional companies used to, do a collateralized lending in that sense that they take a custody of the assets. But with Bitcoin, and what brings us to the next question, what is Bitcoin in general in terms of lending? In Bitcoin, you can do things different, and it's not bad, or it's not necessarily something worse for a lender or for a custodian. It's just different, way more efficient, and specifically way more forward thinking towards your customer, which is the end borrower, who are you providing the services. So I generally disagree with the custody thing. I think I will always disagree with that because, again, we saw BlockFi, Celsius, multiple companies. There was like Voyager, which was it was a good company, blew up. So it doesn't matter whether you run it from your garage or you have an office on the Wall Street. It's a question of how you build your product in a way that you can appeal both to Bitcoiners and both traditional finance people. So number one issue, of course, mingling of the funds, right? It's true. You need to be always over collateralized. You don't mix them. You need to store them in a separate multi-signature account, which we do, multi-signature address. You don't replicate the fund, but also what I said in the beginning of our panel, which we did with you in Madeira, was that I think the yield generation products on top of Bitcoin should actually die, because it's Bitcoin itself is already yield generation product. It's already asset that actually generates you yield. So here's my strategy if you want to generate yield on top of Bitcoin, right? You buy Bitcoin, you buy hardware wallet, you send your Bitcoin to the hardware wallet, you forget about it. In 4 years, your yield is generated. So it's that simple. You don't need to do anything, because every time you think about, okay, I want to earn extra 3%, 4% on top of what I'm earning with my asset, you ask yourself from where yield is coming. If you cannot answer that question, probably you are the yield generational asset with you and your Bitcoin. So I think that was the main reason that people get greedy. Of course, greed is good, Gordon Gekko, right? But it's not good when we're talking about Bitcoin, specifically when we talk about yield generation products. You know, greed is good. Hold your dear Bitcoin, hold your keys, don't give up on custody. If you have to give up on custody, at least make it collaborative custody. At least hold one key and make sure that if you borrow against your Bitcoin is stored in the multisig. It's not replicated. It's technically impossible to replicate one. And that you as a private individual has a proper risk management in that sense that you don't borrow against all your stack. You always have something. In case of the LTV ratio is falling down, you can always add more to collateral, because that's the best way to avoid liquidation. That's the best way to go forward.
Today's video is sponsored by Stampseed. Don't store your Bitcoin in cold storage without stamping your seed phrase on an indestructible titanium plate. Stampseed is fireproof, rust-proof, impact-proof, and easy to hide. It has no loose parts and will give you ultimate peace of mind that your Bitcoin is safe and sound for the long term. Click the link in the description below for 15% off your stamping kit. Welcome to Bit Intelligence. We are committed to bringing you top-notch Bitcoin-only content. Subscribe to our channel and hit that bell icon. Okay, back to the video.
And again, I think the main thing is that we need to teach Wall Street, because I think we should do a heavy lifting, you know, not only provide them with the tools, but also talk with them, is that Bitcoin is a unique, it's not digital assets, it's a super collateral. We need to teach them that actually Bitcoin collaborative custody is possibility, and every sane Bitcoiner is going to be your customer if you will offer a service that is not replicating his fund, and that gives him certain level of control and trust in things that you're building or doing, or whatever services that you're providing. I share the sentiment, but again, I'm more positive on that side that, you know, we can and we will provide tools. I mean, in general, as a community. So, because again, my thesis in that sense is that every major financial institution, every bank out there, the big one, have at least hundreds or even thousands of people who own Bitcoin among their customers. And at some point, those customers are going to go to that bank and gonna say, okay, guys, I don't want to sell my Bitcoin. I have Bitcoin. I don't want to sell my Bitcoin. I want to borrow. But we have a long-term relationship history here, right? And I want to borrow from my bank. Can you offer a proper service to me? And they said, if you're lucky, they will probably say, yeah, you can custody your Bitcoin with us, and we'll give you a 50% LTV ratio. And in case something, we're going to liquidate you, which is fine. That's how business works. But we can replicate your funds. You know, I read those blueprints, you know, terms of services. There's always a possibility to be replicated in that sense. And most of sane Bitcoiners, I would say, they're not going to agree with that. Going to go to another bank, probably might be able to provide a non-custodial setup, a multi-signature setup for your lending and borrowing. it's actually already happening in certain regions. For example, in Switzerland, you have these banks that work with digital assets. They can custody your funds, they can custody Bitcoin, other crypto assets. And we actually been approached by several customers of these banks who told us, like, guys, I can introduce you with the people from that bank. I want to borrow from them because it's like we have a long-term relationship with that bank. I trust them. But as a Bitcoiner, I don't trust any custody apart from my own custody or collaborative custody. Can you please provide this service to them so I can still borrow from them and they will be my lender, but the Bitcoin that will be holding collateral will be holding a proper multi-signature setup. And we're now talking with several of these banks. And I think these use cases are going to grow. As the price of Bitcoin will grow, there will be more and more people willing to borrow against that. And there will be less and less people willing to sell that because the cost of opportunity is very high. We already have a core layer of people in Bitcoin community, let's say the existing Bitcoin community, who already understand the long-term value of Bitcoin, low time preference people, generational wealth, all these things that for us, it's not just sound, and just words. And I think as more and more people will get to the Bitcoin, obviously some of them will go through custodian, through, large institutions, but then again, every cycle we see that people get burned because of the greed, because of trusting, because one of the core mantras in Bitcoin is not only hold your keys, but also don't trust, verify. You don't need to trust. That could be a problem for people or for institutions that actually they have a long-term experience in custody funds. And again, I don't see anything bad in custodying certain assets. I see bad when you need to custody Bitcoin because there's a lot of tools that can allow you not to do that. It won't be less convenient than when you custody funds. Actually, you're taking like extra risk when you custody customers Bitcoin, I think that multi-sig and again, collaborative custody is less riskier also for a lender or for potential custodian. So if you offer that type of service, there's it's distributed risk, I would say. If we figure it out, a new term, distributed risk. So it's kind of, I think, a proper risk management here, even better for a potential custodian.
As the Bitcoin community continues to shape the financial frontier, Max K's insights remind us of the power of self-custody and collaborative solutions in lending against Bitcoin. Let's heed the call to uphold the ethos of Bitcoin while paving the way for innovative lending practices that empower both borrowers and lenders alike. Stay tuned for more enlightening discussions and remember to subscribe for the latest recaps, insights and films about all things Bitcoin. If you want to watch another one of our podcast recaps, try this one here. We'll see you next time.